See, next thing is the NRV. So net realizable value is the estimated selling price. It is not the selling price on the last day, on 31st March. It is estimated. That means it's like a subsequent event. We are going to come across this in Ind AS 10. In the ordinary course of business, less your cost of completion, suppose something damage and all happens to complete that, and an estimated cost to necessary to make the sale, like you are going to pack that, distribute it, whatever it is. And it is different from the fair value because NRV is the entity specific value and may not be equal to the fair value less cost to sell. Fair value, when we talk about Ind AS 113, there we speak that irrespective of whether you want to sell it or not, because your inventory is a non-financial asset. When it comes to 113 fair value, 113 fair value says whether are you a financial asset or are you a non-financial asset. Because if it is a financial asset, universally the measurement principles are same. What is that? Present value of the future cash flows. But when you talk about non-financial asset, that non-financial asset can be put to multiple uses. Your financial asset is put to only one use as an investment. But non-financial asset can be subject to multiple use. There is some concept called the highest and the best price, best use. Those things are not applicable for you to value your inventory. Followed, no? That's why, again, high academic at this point of time, doesn't make any difference in your calculation. An entity holds the inventory of 10,000 units and it can sell in the market 10 rupees. Generally, if anybody wants to buy from you, 10 rupees. But if you can sell, you have got one open order, which you can sell at 11, then, and the incremental selling cost is 0.5, fair value is 10, but your NRV is 10.5. So that means you can value more than at a fair value, because it depends upon how much orders you have got in your hand or what price you plan to sell it. If the entity writes off the inventory due to lower NRV, then from then onwards, every subsequent year you have to make an assessment whether should you reverse anything, and if NRV is more, the earlier write-off should be reversed, not more than that. Same concept like my PP. Clear now? It can be more than, it can be different from, it can be less than fair value, whatever. It all goes with the, that's what I said, entity specific. Now, don't bother about the fair, it's an academic thing here. It is different from fair value. Fair value means the third party, how much you are willing to sell to an arm's length price. But it can be possible that you have already some orders negotiated at better prices. So if you want, if you have got that, you can value it. This is the principle behind the NRV. Okay, so now we will see some theoretical questions on NRV. This is your illustration 12, which has been asked in RTP also. Recommend whether the following cost should be considered while determining the NRV. When you calculate NRV, should I consider the cost of completion of work in progress? Yes, it's the cost to sell should be, cost of completion and cost to sell should be included. Trade discount. You have planned to give one trade discount. List price is 10 rupees. Your trade discount is generally 1 rupee. Included. So what is my NRV? 10 rupees or 9 rupees? 9. That's why trade discount is part of my NRV. Is it a negative? Cash discount? No. So how do you write in the exam? So first you say that net realizable value, give the definition. It includes a less estimated cost of completion and cost to make the sale. So work in progress is a cost to complete, completion cost. It should be part of it. Trade discounts are allowed expressly, or you may have the practice, but you have to deduct it from the estimated selling price because that's what you have planned to do. But the cash discount not to be included. That means don't deduct that cash discount from your NR. UA Limited purchased a raw material. Okay, this is that replacement related cost example. UA Limited purchased a raw material 400 rupees per kg, and you do not sell the raw material but use in the production process, like I told you the plastic bag example in that fruit seller. Now the finished goods at which the raw material used is expected to be sold below cost. If it is sold above cost, if your NRV of the finished goods is more, then always you value this raw material at the cost only, whatever you purchased, whether you purchased at a high cost also, doesn't matter. Because ultimately the finished goods, you will realize this money there, but you don't directly sell this. At the end of the accounting year, the company has got 10,000 kg of raw material as inventory. As the company never sells, it does not know the selling price of the raw material, hence cannot calculate the NRV for the raw material. However, you know the replacement cost today because you purchased when the prices were very high and you stocked it thinking that in the future I may need it. After you purchase, the prices have fell down. You feel very unhappy, but what to do? It is your business decisions. You cannot sell this, but it is your inventory. Now, how do you value that inventory? At a replacement price. Why? Because the finished product which you are going to sell, that is sold at less than cost. It's the same question, they twist it and they are expected to sold above, just below they will change into above, then you will value it 400. Clear, no? So that twist may happen in the exam. So first you explain about the theory about the raw material held to be used. You have to check whether the finished goods is above or not. So since the raw materials are finished goods are less than this, you have to evaluate the replacement cost of 10,000 kg at 300 per kg. Simple, all the top portion remains the same. The moment in the examination they say above, this is going to change into 400. Follow? Yes, we have seen some 2 theory question. Yes, one more theory is there. I should have put it here only. We will see that theory and then we will try to solve some problems. Okay, in the NRV, the first one, Sun Pharma has got the following items of the inventory. They have given you the cost also, NRV also. Determine the value of the inventory on item by item basis, group basis. So since they said determine, you need to first say that the inventory is valued at cost or NRV, whichever is low. So item wise item, you will choose specifically, okay, I will value at this, I will value at this, I will value at this, like this. Group basis means which you consider only the total. Say on group basis you will value like this. So the answer will be on group, you will value item wise item like this and it will be 14,290. If I value group wise, it is 14,540. So one will compensate the other. Anyhow, we will proceed. ABC manufactures and sell paper envelope. The stock of envelopes included in the closing inventory is 50 rupees. So this is the closing cost, which has come through inventory valuation technique and whatever, FIFO method, weighted average method, whatever. During the final audit, they noted that on 15th April, 40 rupees per pack is the selling price. So you on 31st March, you have to estimate and you will consider this. And further inquiry revealed that there is a physical water leakage. Accordingly, the following week, that means in the month of say first week of April, 7th of April or 8th of April, they additionally spent 15 rupees for gluing. Now, what is my net realizable value and inventory write down amount? Yes, now tell me, have you understood this? Okay, first of all, how do you value the inventory? Did they ask you here? No, they straight away asked you what is your NRV. They didn't ask you what is your inventory value. So what is your NRV? NRV is estimated selling price. What is your estimated selling price? 40 minus cost to completion. Is there any cost to completion? Yeah, because of this water leakage, you had to spend 15 rupees, no? Without 15, can you sell this at 40? That will be incurred in April, no? Where are you now? You are on 31st March 2011. Now you have got these envelopes whose value is cost is 50, and you know that on 15th of April its price is 40 rupees. And how do you know? Because you are into final audit now. When the final audit will start? From 1st April. Because from 1st April you are full time there in the client location. So somewhere while doing watching verification, somewhere discussion, you came to know the price has become 40. So what is your NRV? Now is it a subsequent event? Or will you take the price of 31st March only? Will you consider this 40 for valuation of inventory on 31st March? Is it a subsequent event? Yeah, since we have not yet done, understand what you mean by subsequent event. Again, you know this, at the interlevel it was there, a very prime chapter. Subsequent event means there should have been some condition existing on the balance sheet date. To simply understand what is condition, uncertainty. Is there any uncertainty on the balance sheet date? Yes, no, because on that day the leakage has already happened. Uncertainty came. Water leakage has happened, no? And you have to incur it. See, if this leakage would have happened subsequently, okay, you may not have considered it. But on that day there was one uncertainty. Again, in Ind AS 10 we will do this, and I will show you which all type of languages they will use to fool. Under Ind AS 10 we have to discuss this. So it is a subsequent event because there is no clarity on 31st March related to the selling price which they may fetch for that inventory, which is subsequently resolved on 15th of April, which is before your finalization of the statement. So you are going to consider it. But can you sell at 40? No, there is a physical damage. Minus 15, so 25 becomes your NRV. Okay, you can just make a note. NRV is, calculate NRV, no? NRV is equal to 40 minus 15. Yes, Prithvi, are you clear now? First question, calculate NRV. NRV is equal to 40 minus cost of completion, not cost of sale. It's 25. Is there any write down required? Yes. Write down is equal to 50 minus 25 is equal to 25. When the, yeah, we can assume it to be the on the date. We can assume it to be on 31st March. Yeah, because already damage has happened, no, there. Damage has happened. Yeah, see again, I see, there can be different thing. Okay, maybe it's a damage. Whatever the market price itself has gone down. Forget about the damage. Market price itself has gone down. So that again, Ind AS 10, we will get a better clarity. See, we will not discuss much about Ind AS 10. I just told you because we have not discussed in detail what is the condition and all. Yes, here the question is NRV. Should we consider this? Yes, we will consider this. And write down will be 25 rupees because my cost is more than the NRV. Okay, so you will say that expected price is so and so. So NRV will be 25, write down will be 25. Now at the end of financial year, company P has 100 units of inventory in hand at a carrying amount of 10. Market price is 8, at which these units can be sold. This is estimated. Now it has got a firm sale contract to sell 60 units at 11 per unit, which cannot be settled net. That means it is not a derivative contract. Sure, it's not a sale contract entered to file a derivative, say. Estimated incremental selling cost is 1 per unit. Determine the NRV of the inventory of P. So what is my NRV? Okay, we'll write here NRV. Yeah, you need to tell me because they say determine NRV. NRV is estimated selling price minus cost of completion minus cost of sale. They said determine NRV, no? So what does my standard says about NRV? This is what it says about the NRV. Now tell me, what is my NRV? I have how much units I have got? 100. Can you tell me the NRV of 100? Should I split it? Yes, I need to split. Thus, NRV of 60 unit is how much? 10 rupees, 10 in bracket 11 minus 1, because estimated selling price is 11 minus cost to sale is 1, incremental cost. NRV of 40 units is 7 rupees 7, which is 8 minus 1. So second part of the question, Determine the net realizable value. Okay, is there any write down, which the question is very silent? Because its book value is 10 rupees per unit. No? How much is my write down? 3 into 40. It is 120 rupees. Followed, no? So my write down will be 120 rupees. So my accounting entry will be P&L account debit to inventory. So total inventory value $60 into 10 plus 40 into 7, 8. See, the question is totally silent. They are not asking all these things. They simply asked you what is the NRV. You could have said simply 10 and 7. But we will explain more, because they may say, how do you account, how do you consider all those things? Yes, next question. A business has got 4 items of inventory. A count of the inventory establishes the amount of currently held. Inventory item 1, 2, 3, 4, estimated selling price, estimated selling cost. Determine the value of the closing inventory in the financial statement. Can you do this? What is the value? So we have got 4 items. 1, 2, 3, 4 item. Determine. Okay, generally we now write the value, one heading. So what is my value of item 1? We can straight away write, no? Because presentation and all you can look later. Item A1, what is my value? 7,300, which is cost or NRV, whichever is low. NRV they didn't tell you. They say estimated sale. So estimated sale minus selling cost. You have to present it. Simply you cannot write like this. You have to calculate the NRV there, compare it with the cost. So since we know this, second part 14,000, third 16,000, and fourth will be 6,000. So you will be present. Later you can do it. You will present it like this. Cost you will plot, NRV you will calculate, compare both, and you are going to write the value. Which one? That's what. You can just write that theory, because again we will not spend time here, because it is a very simple. Our next question is very beautiful. Now from now, yes, you have to high probable questions for the exam. Now opening inventory they have given you, finished goods, raw material, some stock they have given you, purchases they have given you, labor, overhead cost is given. See, the fixed overhead cost means somewhere capacity they should have given you. Now sales and the closing inventory of raw material and FG. Here they have given ulta pulta, please be careful. Here FG raw material, here raw material FG. So some student in that hurry may take some other values. Now the expected production for the year is 15,000 kg of the finished goods. Now due to, and what is your actual production? Sorry, we have to calculate. Correct, no? We have to calculate, no? This is what is purchased. So we have to calculate the sales is there. This is the purchase of the raw material. Then we will come to know, are we efficient or are we inefficient? Due to the fall in the market, the selling price at the finished goods is 20 rupees per kg and the replacement cost is 9.5 per kg. Why they gave me replacement cost? One element of raw material sitting there, closing stock of the raw material. Now this valuation depends upon, are you going to value at cost or are you going to look into the replacement value? That depends upon your FG's valuation. FG is going to get valued at cost or NRV, whichever is low. Have they told me the NRV of the FG? Yes, 20 rupees. What is the cost of FG? That's what we have to calculate. To calculate, don't we need this inventory valuation technique? Question is silent. What we will take? Sorry? We will go for the FIFO method. Because I need to know, no, did I consume, is my closing stock of finished goods, is it coming from the opening stock or it is coming from the production? Followed, no? You are required to calculate the closing stock inventory value at the end of the year. Is the question clear? Simple. In short, they are asking you what is the value of these two items. Is there any interdependency there? Yes. What interdependency? The value of raw material depends upon the value of finished goods. If you value the finished goods at cost, that means NRV is very high. Then raw material also you will value at cost. Otherwise, you have to value the replacement. And to value the finished goods, I know one leg. What is my cost? These are all my cost. Which method is followed? FIFO method is followed. So I need to see that what is my cost of production. For cost of production, I have got one fixed overheads here. How much of fixed overheads will go into this, or will everything I will charge to the inventory cost of production, or something is going to become my P&L? That's what you need to do. Okay, so write solution. First we will calculate the actual production. Actual production is equal to how much? Not required. Why do we need to assume that? Okay, how much is the opening stock of the FG? 200. How much did you sell during the year? Closing is, okay, closing stock is 1200. Did you sell something? How much? That means that you also, it must have come from production. Minus how much is your opening stock? 1000. Is it not going to give you production during the year? Why you want to relate with the raw material and this? See, they told you closing stock of the stock with you. Closing stock didn't fall from the sky. It didn't came just like that. It must have come from production or where? Whatever closing stock you have got right now in your hand, it must have come only from two sources. No, which are the two sources? Either not purchase. Okay, we can say three sources. One, either you should have purchased that raw finished goods, or you must have manufactured that finished goods, or it must be coming from the opening stock. In these three sources, which source is available with you? Opening stock is there. Now, have you purchased anything, finished goods? No. What you purchased was the raw material. What you sold was the finished goods. This much is sales happened. That means this must have been produced. No. Now, what is your raw material consumption? And then we can try to establish the for this consumption, this FG came. For this consumption, this FG came. You cannot say for this purchases, this FG came. Because out of whatever you purchase, something might have been remaining in the stock. No. You cannot establish a relationship between purchase and the production, right? You have purchased 10,000. Did you produce anything? No. Maybe every 10,000 will remain in stock. Now, production and consumption, you establish a relationship. It makes sense. But don't do that. Okay, how much is raw material consumed during the year? How do you get? Okay, how much is the closing stock of raw material with you? Okay, but you are looking into consumption. Raw material consumption comes from opening stock. How much is your opening stock? 1100 plus how much purchases happened? 10,000. How much is the closing stock with you? 900. Is it 10,200 is the consumption of the raw material? Are you clear about these two differences? This is the outcome now. Okay, leave it. Why we will use, we will see. First, have you understood what is your production? Production comes from your closing stock plus a sale minus opening stock. Or opening stock plus purchases minus closing stock gives you what? Sales. Opening stock plus purchases minus closing stock gives you sales. Or opening stock plus purchases minus sales gives you closing stock. This equation is clear now. From childhood you have learned this. If I ask you raw material consumption, opening stock plus purchases minus closing stock gives me raw material consumption, or opening stock plus purchases minus consumption is equal to closing stock of raw material. Is there any confusion? But you see, look at the number, how beautifully crafted. That's why I am telling you, highly probable. Understand this question in principle, because that raw material purchase and raw material sales value, something they may change there. If you see, beautiful, and prices are also same. Purchase price also same, opening stock price also same there. 10 rupees per unit. What if the purchase price they will change in the examination? To check that have you understood what you are doing here, or is it done as per one format? Because it is a simple question. Definitely they will play here. If it was complicated, so many things they would have done, they would not have asked you. So they will change some numbers here. Huh? So for this you understood. Have you understood these two numbers? Yes. So are you clear, Prithvi? So we have got the purchase and the sales. Now let us calculate the cost of production. Why do I need cost of production? See, first of all, are you convinced that raw material valuation I cannot do unless I do FG valuation? Because I say there is one way interdependency, no. Whether FG is sold above cost or below cost, that determines. That means it's a simple thing for me. You evaluate cost or evaluate replacement. Now, so my entire focus goes on valuing that 900 closing stock. To find out the 900 closing stock, first of all, I found out what is my production. Then I will look for cost of production. Why? Then I will see which method of valuation I follow. If I follow FIFO valuation method, whatever opening stock is there, I sold it. Then whatever closing stock remain 900, it must be coming from the new production, no? And what is the cost per unit to produce new item? Into my closing stock is the closing stock value. That I will compare with 20. Have you understood the flow here? Okay, so what is my cost of raw material consumed? To find out the cost of production, what is my cost of material? $10,200 units you purchased. At which value you will issue to the production? At what value? What is your cost? 10,200 units of raw material you have issued for production now. When you issue, is it free of cost for you? No, it must have come through some cost, no? What is that cost? At what cost you have got it? On what basis do you say 10? You must have told FIFO method, no? Okay, so 10 rupees is your purchase cost, or whatever from the here doesn't make any difference. That's what the numbers are very nice. Opening inventory value plus purchase value also same, so it is rupees 10. If it was different, then opening stock you would have issued plus from the new purchases. Suppose for example, if the purchase cost was your, I have given that, later I have discussed, 1,10,000 rupees. That means opening stock price is 10 rupees. New purchase is happening at 11. Then cost of material consumed is 1,100 at 10, and 10,200 minus 1,100 is from 11. Have you understood this? If at all they have twisted their second number. Here it doesn't make any difference, because this 10,200 is coming from two sources. One is from the opening stock, one is from the new purchases, and both are beautifully at 10 rupees. That's why you have to go in detail and understand what these numbers are. So my cost of production is how much now? Cost of material consumed 1,02,000. This is what we started our journey with. Oh, is this part of the cost? Yes, direct cost, allocation cost. There straight away they used to give me number, but where that number came, that we are calculating in detail now. Did you incur any labor cost? Should it be part of your closing stock of inventory? Yes. So what is my labor cost? 76,500. If at all they say that out of this so much is abnormal, minus that particular thing. That means it will not get loaded on the closing stock of the inventory. It will go into P&L. Did you incur any other cost to make this finished goods ready? Overheads, fixed overheads. How much did you incur? 75,000. How much you will charge to inventory? Now that depends upon, are you efficient or inefficient? If at all you are efficient, that means you produce up to capacity or more than the capacity, you charge full 75 to the inventory. Are you efficient? No. So at what rate you will charge? Based on the normal capacity. So can you tell me how much is my value of the inventory here? Overhead I am going to allocate to the inventory valuation. 50? Others, what is your number? I would like to hear at this point of time, because this is slippery area. This is slippery area. This is slippery area. Everyone okay? 51,000? Yes. 75 divided by 15,000 is my normal capacity into 10,200 is my actual production. So what is your total cost of production? 2,29,500. By incurring this cost, how much units you produced? So units 10,200. So COP, cost of production per unit, is 22.50. So your assumption here is the opening stock of the FG. What is your value of the opening stock of FG? 25 rupees. That have you sold or is still remaining in the stock? Sold. Why? Because you followed as a FIFO method. If you have sold that 25 rupees, at the end of the year, whatever you have got now, 900 rupees, it is valued at what? Where it came from? It came from 22.5. Now what is your NRV? 20. 20, no? So are you going to, okay, write the solution. 22.5 is the value. Since NRV is less than cost, stock is valued at rupees 20. Stock is valued at rupees 20. Done. Now what is the value of the raw material? Since FG is sold below cost, RM is valued at replacement cost. So you need not get into the headache of again calculating the raw material FIFO method and all that. Of rupees 9.5. Therefore, FG value is equal to 1200 into 20, 24,000. RM value is 900 into 9.5, which is 8,550, 32,550. Probable question, students. Gives you better understanding about inventory valuation, how it really works. This is what happens in reality. This is where you do it. What happened? Initial bits and pieces we learn. Oh, they straight away tell me the direct material. Where they gave that cost from? It has come from the consumption. And am I supposed to establish one-to-one relationship there? Not required. If labor cost and all they say, then we have to have that understanding. How the allocation? Here my allocation is simple. Okay, done. Now in the examination, there can be 90% probability that Chances I am telling you. Probability, this question may come as it is also. Nice. You can do it as per. First you find out the production, raw material consumption, cost of production, say the valuation. What if they say raw material is purchased at 1,20,000? FIFO was our assumption sitting here. NRV is 30. Then cost of the material will be like this. You have to split it. 1,100 will give at the opening cost, and that additional units will go at the new cost. So this becomes the cost, and you value at 24.28. Rest everything remains the same. Since it is NRV is more, you are going to value at 24.8. Are you clear? And the low 50-50 chance, okay, raw material is 150. Weighted average raw material cost is 11.8. Okay, so what they said, raw material purchase cost is 120. Okay, what I am trying to tell here, weighted average method they may use instead of weighting. Then weighted average cost of the consumption of raw material I need to check. That means opening stock plus purchases divided by the total quantity. I get the weighted average price. There I split, no, this much is raw material from the opening stock, this much from here. Here I will take the weighted average price. Just everything remains the same. Are you clear? Understood? Okay, next is the joint and the byproducts. A small theory. Yes, we will understand about the joint products and the byproducts. Now, when there are more than one products are produced, now we may call it either a joint product or a byproduct. That goes with your judgment application. Generally, they would have told you. Now, if the conversion cost you can identify separately, like how much is the joint product conversion cost, yes, based on the separate costing you allocate it, finish, no headache. Like joint product means what, first of all? Like when you produce something, like two products will come. For example, you have any examples of the joint product? Yeah, our old traditional, when we produce sugar, molasses and bagasses are going to come, something like that, no? There may be byproducts. Okay, main product is the sugar. Okay, so there are byproducts. Something like joint products means you produce actually from using one raw material, you produce two items. Sorry? Tender coconut, you want to sell the tender coconut this thing, and from the outer cover you prepare something artistic thing, and both are your good sales. They are joint products. You don't give equal importance to one there. Both are equally good products. Followed, no? That's what it goes with the judgment. You have to go understand the business processes, look into their operating segments. So joint products means they are main products. If you say that I have got one main product, then what other things are, then that is a byproduct. It just happened, so I just want to get rid of it. Joint means I give importance. I have got a marketing strategies there, how to sell it, I fix the price, I consciously give ad, because it's my main product only. Now, for the main products when you produce, we go what you call joint products. See, till now we had got only one, so no headache. What about the direct material cost? What about the conversion cost? Labor you have paid both same, no? At the same time you given both. But costing I need to do two separate things because both are lying in my stock. So if you can identify separately, you do it separate accounting, well and good. We don't, if that is the case, they will not ask me question here. But if you cannot identify the conversion cost separately, because it can be the same person, you are paying 10,000 rupees per month. Same person is working on both the sides. Then you should allocate based on a reasonable relative sales value. You distribute it. Sorry, 115. So somewhere SSP based we distribute, no? If we cannot identify the cost, you allocate it. That's it. Then rest everything moves like normal thing on. What about the byproducts? If byproducts are material, like you say molasses and bagasses or whatever it is, but your sales are very significant there. You don't sell it like a scrap there. Then you treat like a joint product only. So for you it is a byproduct, but for accounting purpose it is a joint product. Why? Because it is very material. You may say, I am not interested, sir. Or you may not be interested, but I cannot value that at a scrap value. No. Accounting wise, we will value it. If you want to tell people that it is not important, go and tell. But accounting wise, I will give the treatment like this. But if it is a really a not material, then value the byproducts at NRV and deduct it from the cost of the main product. It's like a scrap sale. In one of the problem we did first, material cost, like I am doing that gift card items, I am cutting. So while I am cutting, some paper pieces will remain. That's my byproduct. Suppose I have to make one visiting card of one particular shape. I got one A4 shape. While cutting, some pieces, paper pieces remain. What I will do? Will I burn it? No, I will accumulate it and one day I will sell it. So in the process of making visiting card, I get certain pieces of paper which is of use to me. It is the byproduct to me. I don't value. At the end of the year, I have that much of stock with me. So what I should do? I should value at what is my scrap value, but don't show it separately as an inventory of my byproduct. Deduct it from the value of the main product. That's it. This is the treatment. With this, we are done with the inventory valuation. We'll just see first, okay, there are some theory questions, which is an L3 level questions. We will see that later, but before we'll solve some problems. Then we'll come back to the theory. Joint and byproduct problems. Okay, are you clear with the previous questions? See, please mark at the end of the day which all important questions you have to practice. Simple, certain questions are only academic. So joint and the byproduct. See, this question is a very important question. I think it has come also for the exam. Now, in a manufacturing process of solar limited, one byproduct BP emerges besides two main products, MP1, MP2. So MP1, MP2 are the joint products. Besides, some scrap is also there. There is one byproduct, two main product and some scrap. Total cost of production processes are raw material 14,500 units, wages you have incurred, fixed overheads, look for capacity, variable overheads not required. How much output produced? MP1 5,000, MP2 4,000 and byproduct 2,000. Was there any opening stock? No. Nice. So FIFO weighted average headache is not there for me. If opening stock was there, I should have taken an assumption there. Now closing stock is 250 and 100. Okay, so I don't have they given me any closing stock of the byproduct? No. Now average market price MP1, MP2 is 60 and 50. Byproduct is sold at 20. There is a profit of 5,000 rupees on sale of byproduct after incurring separate manufacturing, separate processing charges, because it is immaterial. That's why they didn't want to show the cost of this. MP2 byproduct they didn't show because they are telling it is immaterial. That's why they sell that byproduct. They don't want to retain with them. So there is and they have sold it actually. Whatever they produced, since the closing stock is not available, what will assume? They must have sold it. And they have sold the byproduct after incurring separate processing charges of 8,000 and packing of 12, and 5,000 was realized from the sale of scrap. Some scrap also they generate, no? Now what is the value of the closing stock of MP1 and MP2? Perfect. Why? Byproduct I have sold. Scrap also sold. So what is the value? Note the profit of rupees 5,000 on the sale of byproduct. There is a profit of 5,000 on sale of the byproduct. This sentence has got no relevance in calculations, and I will believe that this will be removed in the examination question. This may be to confuse you that there is a profit of 5,000 rupees. The amount of 5,000 is included in the total profit of whatever 30,000, whatever they are going to sell. Okay, so we will discuss it as we proceed now. Then you understand that this sentence, profit of 5,000 rupees by sale of byproduct, it is already part of whatever you sell. Simply they gave you there. Keep this in mind. Huh? This has got no relevance at this point of time. Okay, so write solution. Solution as per Ind AS 2, byproducts and scrap are measured at NRV and deducted from cost of main product unless material. If it is a byproduct is material, then you would have said there are three products, main product 1, 2 and byproduct. But you assume that byproduct is immaterial because they have sold it, no stock they have retained. So as per Ind AS 2, if the byproduct and swap are measured at NRV and these values are deducted from the cost of the main product unless they are material. If it is material, you would have treated. So first you do working note number 1, calculation of NRV of byproduct. Calculation of NRV of the byproduct. What is your selling price? At what price you have sold the byproducts? 20 rupees. They said no, selling price of NRV is 20. How much did you produce? 2000. Was there any opening stock? No. That means whatever you produced during the year, you sold. If there was opening stock, then it's the opening stock plus what you produced is what you sold. So total 40,000 you got from the sale of this. Was this free of cost for you, byproduct? No. What did you got this? From the NRV, what you can deduct? Processing charges. You could not sell it as it is, processing charge, because you had to process it little further, not complete. When the byproduct came, you had to process it. Say for example, paper pieces came. Paper pieces you may not be able to sell as it is. You have to shred it and sell it. So shredding charges, how much? 8,000. So you have got a shredded paper now. Now can you sell it as it is? No, you have to keep it in a box and sell along with the box. So plus here, plus packing charge. Minus packing charges. Because if you have to sell this byproduct, 40, yes, you would have realized, provided these additional two costs are incurred. So what is your NRV of the byproduct? 30,000. What is your NRV of the scrap? 5,000. Now that profit, what they said, no, they sold at a profit, that is already part of this 30, and it is a confusing statement. It has got no real. What is the meaning? You sold at a profit. Did you sell at a profit? Did you sold this at a profit? Yes. Why? Because this is the total value you realize. This includes profit. No? What you are supposed to deduct from the main product? NRV. That's really, because that's what you should do. That's what practice is, to dispose it off. At what value? NRV. So that NRV sale includes an element of profit. Okay, no. It has got no relevance there, okay? Okay, to tell you like this, there is a profit of 5,000 on the sale. So selling price is 40, say selling cost is 10,000, so you got 30,000. Say for example, you have got some separate records and you said that okay, for this raw material, wages, etc. is this, how much balancing figure. So what is your profit? 5,000. This is what they said. Whatever you can sell and realize 30,000, it includes the profit. So clear, no students? Simply to confuse, see, now what happened when you reading this, you get worried. What is this 5,000, where it gone, what is going to happen in my examination? Okay, all the questions like this only, where all confusions are there, what if they are going to give you? No. Let's say you see the examination, they removed it. Okay, what is the meaning? If you really want to understand, they say that, look, whatever NRV you sold, it had a profit. Okay, no, Baba, who is interested in the profit? We are interested in NRV. Clear? Yes, so we will move to the calculation of the cost of conversion for allocation. Because they didn't tell you specifically what is my cost of conversion for main product 1, main product 2. Because they asked me valuation of inventory. Valuation requires my cost of conversion, no. Cost of conversion includes my direct cost also. So first thing, did I incur raw material cost to produce both MP1 and MP2? How much? 1,50,000. There was no opening stock, so 1,50,000 rupees I incurred. Did I incur wages? Yes, 90,000 rupees. Fixed cost, how much? Now immediately you should see what is my capacity. Have they told you? No. Right, take full 65. Assumed to be, achieved to be normal capacity. Variable, doesn't matter. Capacity is secondary for me, 50,000. So this is my cost of conversion of your two productions, that MP1 and MP2. Whatever I produced, MP1 and MP2, its cost. But what does my standard says? In this process, you got byproduct and some scrap. What you should do? You deduct minus NRV of BP1, 30,000, scrap 5,000. So this is your total cost of conversion, which you need to split between MP1 and MP2 based on relative selling price. Easy question, right? Based. Which one? Which three numbers? Profit and all. Yeah, it is the confusing thing. Is no, that's what no. They will. This is what I'm telling you. Please be comfortable. Immaterial. That's what we started when we were writing theory, that byproduct is an immaterial. If it was not immaterial, what would you have done? Chalo, one twist. In new syllabus, they give you one twist, new product. Then you would not have minused it here. And when you distribute to 3 people now. Byproduct also. It is not there. It's not that concept here. Okay, how much valuation means? See, that means entire it as a COGS now for you. You have sold it. It's not because closing units were not there. What is your business practice? Is that byproduct is immaterial or immaterial? If at all they give you hint that byproduct was material, some value should go to that byproduct also. Okay, what if main product 2 there was no closing stock? Every cost of production will you allocate only to main product 1? If the closing stock was there for the byproduct, okay, what you could have done? No. That closing stock value also, yeah, okay. Chances are low in the examination. We have got a proof, but yeah, very nice question. If at all closing stock, okay, if at all, say out of academic thing you asked me, if at all closing stock was there for this, first tell me, is that byproduct is a material or immaterial? What is yours? Immaterial. Same story. Then in the first stock, when you minus this, how much you multiplied? Full production. If closing stock was there, then you would have multiplied with 1,800. Followed, no? Plus 200 into the cost. Because closing stock also should be reduced, no, from the valuation of this. Because that much production happened, but certain portions you are not able to sell. So some portion you will keep it in a stock, maybe at a cost. Again, standards may not tell you everything. You have to go and apply, understand, is it my asset, what should be value. That by products also you may value at some cost. But that also cost you will deduct it from here. So I'll go back to the first step. In the first step, you decided the selling price. If there were 200 stock, then you would have taken only 1,800 plus, again you would have taken full 20 into 200. That's remaining with my stock. No? It doesn't make any difference. Even though it is there, you will value maybe valuing at what is it called, NRV. Which one? No, see, you are not selling here. You have sold here. Even though you would not have sold, I think you should give the same treatment. Full 2000 only you should take, because you should not recognize that as a, because it's an immaterial thing. No, you should not recognize as a closing stock of byproduct in my balance sheet. Whether you sell, ignore it, because it's immaterial. Now, starting with that, I asked you, is it material or immaterial? So if it is closing stock was there also, what you can assume it, see, since it is immaterial, what I will do, that much of worth, what it is worth 20 rupees, I would have deducted it from the cost of production. Like you drank one Pepsi, that Pepsi's bottle is your byproduct for you, that cap. It is remaining with you. Whether you have sold it, returned it to somebody, or it is there with you, it has got some value. But what is your cost of the Pepsi? If that Pepsi bottle can, this thing, the cap can fetch you 1 rupee, you say my cost is 39 rupees. No, now I'll ask you, did you sell that? No, that cap is there in my pocket only. But it is worth 1 rupee. If not now, I will sell next day. But cost is 39. So whether I have sold it or not sold it, since value is immaterial, I will not have recognized it as an inventory, but I would have followed a practice of deducting it on. Followed, no? Anyhow, not, don't worry. We'll solve the next exam question. We'll see that. Okay, next is the allocation. Closing stock value. Okay, right? Allocation. Okay, now how much cost did you incur? 3,20,000. How you are going to allocate it? To MP1 and MP2. So cost allocated based on the sales value. They said, so what is my total sales value? You can't allocate based on the sales price per unit. Followed, no? Why? Because it's same like that you building example in impairment. Life of the building 10 year, another building 20 year. You are going to take a weighted average. So what is the total sales value? 5,000 units into 60 for MP1, 3 lakh. 4,000 units into 50, 2 lakh. This is the weighted average number. If you take 60-50, it is a very plain, okay, with a plain ratio. This ratio is better because you are considering quantity also. So, cost of rupees 3,20,000 allocated on 3:2. So, it comes to 1,92,000, 1,28,000. What is your output? There was no opening stock. So, you produced 5,000, and you produced 4,000. So, COP, cost per unit, 38.40 and 32. Yes. So, the value of closing stock is 38.40 into 250, 9,600, 3,200. Are you clear, students? Simple, right? So, you understood the process also here. Again, they will test only this concept. Don't expect that this they will mix with that raw material consumption. Separately, I have to calculate, find the value. That's a very rare thing they would have asked you. Done? Complete? Yes, so we will move on to the next question. Yeah, please don't see now what we have done. So you have understood now what it is. And see, in this examination question, see, they removed it. Nice. How many marks? This question? 5 marks. Calculate, no theory. Allocate, joint. See, look, what is this question? This question is calculate the value of the closing stock, which is the same here if you see this particular part of the question. allocate the joint cost based on the relative sales value of each product. Okay, there's only one question, but they said very clearly how I should do the allocation. Yes, so students, please pause the video, do this. Okay, so it's a straightforward question. I don't think so there is any catch. So first thing, you will have calculated the NRV, which is 40,000. And this includes whatever profit, if at all they would have given you, maybe in the new syllabus. Done. Then you have got the raw material cost, wages cost, fixed overheads, and you deduct the NRV. So 13,60,000 becomes the joint cost, which should be allocated for two products. They said this will be allocated based on the relative selling price. So you get the total sales value 9 lakh and 6 lakh, 9:3:2, same ratio. You allocate both the things and you get cost per unit 40.8 and 34.34. They didn't ask you to calculate the value of the inventory. Okay, so they simply asked you the allocation of the cost. If you have calculated the value of the inventory also, fine. Okay, they told you, yeah. Determination of the value of the inventory. So you just have 40,800, 13,600. Okay, if they don't, you can always calculate it. Are you clear? Yes, so some 3 nice theoretical questions are pending now, which is a mixed question. Okay, so now you have understood the inventory valuation very clearly. So I wish you answer me all these questions, whatever I am going to ask you.